HIN number? Custodian? CHESS sponsor? CHESS? If you're new to investing in the ASX, then all of this jargon is going to sound very strange to you. Like, what does a game of chess have to do with anything? And why do you need a sponsor? Today in this video, I'm going to break down the differences between a custodian style broker and a CHESS broker, and why that's the most important attribute that you should look for in a broker when you start investing in shares in Australia. This video is sponsored by ThinkMarkets, offering CHESS sponsored investing at just $8 per trade. Now, before we begin, let's get the basics out of the way. CHESS is actually an acronym that stands for Clearinghouse Electronic Subregister System that's used by the ASX to try and manage transactions and to record who owns what in the fast-moving stock market of ours. A HIN number is your unique identification number that identifies you as the owner of the stock and has all of your personal information against it. Think of it like your mobile phone number, where no one else can touch it or have access to it without your express permission. Now, a CHESS broker will sponsor your HIN number to try and make trades on the ASX. Think of it like a mobile phone carrier that services your mobile phone number and puts it out on the telecommunications network. So every time you buy a share, that quantity of shares is assigned to your HIN number, and it'll stay there against your HIN number until you decide to sell it. And that's essentially what a CHESS broker will do for you. It receives the order to buy or sell from you and then reports it to the ASX settlement system and clearing system to be able to make those trades. Now, whether that's directly through the ASX or a third party, both of them will charge you a fee for every single trade that you make. And that's part of the fees that you pay to the broker every time you buy or sell and make a trade. Now, in order to skip some of those clearing fees, some brokers are using just one HIN number, which is their own, to store and own all of its customers' shares that they own. And that means that they only need to pay a one-time fee for each company's net positions at the end of each trading day, regardless of how many times it got traded back and forth. It also means that if just one person traded some really obscure share just once for that trading day, they will need to pay the same clearing fee as for, say, a big company with lots of trades. Let's say for CBA, they'll be paying the same price for both of those companies. So this is called a custodian broker, and this way they are able to keep the cost of each trade down, but it also means that they need to have a large team to maintain a subregister of who owns what in their own systems. So in theory, that actually does sound like a good idea. Well, maybe not so much for the ASX clearing company that misses out on all the trade fees, but it's good for the everyday person that's just looking to save money on the trade fees when they start investing. Now, there are two main problems with this custodian model. The first has a really low probability of it happening, but at the same time, it has a very high consequence for when it does happen. And that's if the broker ever goes bankrupt and then shuts down the system which records all of the ownership of the shares, then it can get very difficult to work out who owns what. You might say that, hey, the ASX and the share registries will know. But to the ASX, for all intents and purposes, the sole owner of all of those shares is the broker. The system was designed for the custodian broker to maintain its own ownership records, and if they ever run away or go under, then it can be really difficult to prove that you are the rightful owner of those shares, especially if they don't maintain their records properly or if it just gets lost. Now, this happened to a broker called BBY, who maintained the portfolios of about 6,000 clients, and then it went bankrupt all the way back in 2015. Now, BBY is an interesting case to look at because they had some HIN number investors and also had some clients that were on the custodian broker model. So when they went bust, the HIN number investors were pretty much just prioritized straight away by the ASX and moved all of their portfolio holdings from BBY to another broker with ease, without any issue at all. But for any of those clients that were still on the custodian broker model, then to this day, those clients are still yet to receive the final distribution of their money almost 6 years later. 6 years. But luckily for them, KPMG, who were appointed as the liquidators of BBY, have given them a schedule as to when the last payments will be made. But that's after 6 long years of waiting through court claims, and even then, they would have been able to retrieve less than 3/4 of their equities. Now, that shortfall is due to keeping poor financial records, and in some cases, even transferring client funds around, even to external third parties, which is very worrying. Now, the second problem with using a custodian broker has a much lower consequence, but a much higher probability of it happening. And that's the lack of communication, transparency, and portability that is associated with custodian brokers. And that's just purely due to having a middleman broker needing to pass on all the information from the publicly listed company to you as the shareholder. So of course, it will be harder and more expensive to move from a custodian broker to a CHESS-sponsored broker because the system don't interface very well. They're on different sub-registers and the brokers could have their own way of maintaining records, whereas the CHESS model is standardized for all CHESS-sponsored brokers. And also, if the custodian broker doesn't do its due diligence, then the opportunity cost of missing out on things like, dividend reinvestment plans or voting rights or even share purchase plans can be quite substantial, especially if you think about how many clients that they would actually be servicing. And ASIC obviously thinks the same as well because they just recently fined Westpac's custodian broker division for exactly that same offense. Now, this is Westpac, a well-trusted brand, was found to have failed to notify of around 300,000 corporate notifications to its shareholders. Now, that's a lot of missed opportunities considering how many clients that they have, and so it kind of all does add up. So I'm not bringing up these two problems with the custodian broker to scare you, but rather to raise the fact that they could happen. Sure, the custodian model can work for some investors, especially if their portfolio is a little bit smaller, but I think that as you regularly contribute more and more to your portfolio, which I really encourage on this channel, by the way, then the risks will get significantly larger and larger, and you're better off just paying a CHESS broker a few dollars more each trade to try and minimize that risk completely. So before we end this video, let's actually take a quick look at the costs of investing through these two types of brokers. First are the custodian brokers, among which the newest broker, Superhero, is the cheapest, offering just $5 trades. Interactive Brokers is another custodian broker that charges a little more with a percentage commission of 0.08%, but sets a minimum fee of $6 per trade. And IG Markets rounds off our custodians with a trade fee of $8 per trade. And also, at the time of recording, Stake is also planning to come to the ASX party, very likely with a custodian model as well, considering they use the same financial services license as Superhero. But we shall see once they release more info. Now, on the other hand, here are a handful of the CHESS brokers. Now, the CHESS brokers were always going to be more expensive, but surprisingly, the cheapest of the lot can match it with the most expensive custodian and still offer the security of a HIN number. So ThinkMarkets is definitely something to consider if you want to minimize those trade fees. Self-Wealth is a little more expensive at $9.50 per trade, CMC Markets at $11 per trade, and some of the other bank brokers are easily the most expensive to trade with. Although CommSec does provide some value because of their vast research platform. Now, personally for me, I'm more than happy to pay a few extra dollars to completely remove the risk of the broker defaulting and then completely losing my portfolio. It very likely is not going to happen, but the thing is, you just never know, and I personally just don't want to be caught in that position ever, especially as I contribute more and more to my portfolio, which then gets bigger and bigger. The risks of it happening also gets bigger and bigger. So for me, personally, no HIN number, no thanks. Alright, so thanks for making it this far, everyone. If you're planning to start ASX investing, then which broker are you planning to use? The safer but more expensive CHESS broker, or the cheaper but riskier custodian brokers? Let me know in the comments down below. Thanks for watching, and as always, I'll see you in the next video.